Good afternoon. Thank you all for joining us. I'm Kate Valentine, host of the Keyword Podcast, and welcome to our webinar. We've been partnering with Global Wired Advisors over the past month, talking about getting your business ready to sell, but really important here, selling it in 2020. Our very first episode we did with them in January kind of talked about why 2020 is a great year. If you have not listened to that, we're going to cover a little bit of that in this webinar today, but you can also go back and review that as well. Any questions that you have, this is just a housekeeping note, we will have time for questions and answers at the end of the webinar. So any questions that you have that come up, go ahead and post those in the chat. Share your questions there. I will be saving them, and I will bring all of those questions to our Q&A at the end after I have given these guys time to present. Also, another housekeeping note, we are recording this. If you would like access to that recording, we will provide it to you afterwards. I'll send out an email probably later tonight with the full recording. So if you have to duck out early, or maybe you've missed this first part, this is being recorded, so we will share that with you. I'm going to introduce and turn the time over now to Joe, Jason, and Chris. Thank you guys for joining me.
Thanks, Kate.
And I'll let
Kate.
you.
It's good to be back on.
Yeah, I'll let you guys take it from here.
Yes, thank you so much. We love talking to your audience, and we love talking about the topics we're going to talk about today. So, for those of you who don't know who we are a lower middle market investment bank based here in Charlotte, wonderful Charlotte, North Carolina. All of our backgrounds come from, more of a corporate institutional investment banking background. And we love the lower middle market space because we believe that you, as an owner of a business, just deserves a better process when it's time to go to market. And so today is all about sell your business in 2020 with max reward and minimal risk. So we're going to be walking through a couple different topics. Jason's going to walk us through 2020 and the best time to sell your business. I am going to walk you through the selling process using an M&A advisor versus a business broker. And Joe is going to finish with the what factors into your business's valuation. And as Kate said, we'll end with Q&A. So I'm going to hand the microphone over to Mr. Jason Somerville and let him walk us through why 2020 is a great time to consider selling your business.
Great. Thanks, Chris. Thanks, Kate, again for hosting, and to all of those out there tuning in. Hopefully you'll find this to be informative as you consider, how to approach the year from, an exit planning perspective. And so I'm going to jump right in. We're going to start off with everybody's favorite topic, a little macroeconomics. I'm going to try and kind of lay some groundwork here and really point out kind of what the key drivers are for why considering, exiting your business this year might be a really good idea. So let me start out with a little bit of 2020 macroeconomic outlook, because it will, again, build a little foundation for our ultimate conclusions. So kind of going through some of the highlights in terms of where the U.S. economy really is currently. Most U.S. economists do feel that we're sort of at or near an inflection point. And what that means is really we've been kind of going through a growth cycle for quite a while now, going on a decade. And many economists believe that that is likely going to be coming to an end sometime in the not too distant future. We'll have more on that in a moment. But as many of you are probably aware, the employment environment remains very favorable. Unemployment is at really historic lows, while inflation is also very low and manageable, and certainly in line with growth overall, which is sort of what you want. And finally, which this isn't on the slide, but we're starting to see some real kind of wage growth as well, which is good. That's been one of the areas where the economy's lagged a little, even though it feels like many people are employed. The wages that those people are receiving has remained a little behind, but that's starting to change. The yield curve's flat. It's actually inverted at times over the last year. we'll have a little more on that soon. And here's kind of how the current economist sort of curve breaks down in terms of predicting the next recession. Right now, about 14%, and this is according to the latest Wall Street Journal survey of economists, about 14% believe we'll start a recession this year. About 31% say it'll be next year, and basically the same amount say it'll be the year after that. I'll show you a graph on the next slide which illustrates this, but that's sort of what the opinion kind of is, the consensus, which you can't really call that a consensus, call it more of really a division around what's likely to happen in the U.S. economy from a recession standpoint. GDP is forecast currently to be below 2% this quarter and be around 2% for the year, which is pretty much what it's been over the last year or two. Trade policy has been a bit, very hot topic in 2019. It'll continue to be a focus this year. We just had a phase 1 trade deal that got signed with China. There's still a lot of questions around that. There's a lot of questions around how long that might, be in place before something else happens. So trade policy is a key driver for deal activity and the economy this year. And lastly, CPI, which stands for Consumer Price Index, which is usually a primary indicator of inflation, has remained pretty steady actually throughout 2019 and is expected to be pretty steady in 2020 at around 2%. So on this next slide, you'll see the histogram on the left is really just illustrating what I cited before about what economists believe, when economists believe the next recession might start. And then the other chart here is showing what the consensus is around whether or not the next move by the Federal Reserve will be an increase or a decrease in interest rates. As you can see, that's almost 50-50. So both of these really reflect kind of a difference of opinion across the board. There is no real consensus, as you can see. Next slide gives you a little more info on the trade policy. This is just a survey question around, what the impact will be on the phase 1 deal of the China, between the U.S. and China. It really looks like, the answer, a small plus for the economy, really is kind of the runaway choice there from economists. And then the graph on the right is actually the GDP graph that I referred to before, showing what that's been over the last couple of years and what it's projected to be this year. So you can see right around 2% for the U.S. economy in terms of growth. So that was, just again, a little bit of macroeconomic data, which I'll refer to more in terms of what role that plays in your choice or potential decision to look at exiting your business in 2020. Here are some of the other key M&A themes for this year that we and really the rest of the market are really focused in on. First and foremost, everyone's talking about the elections. And regardless of where you may fall in the political spectrum, it seems to be fairly unanimous that it's a focus. It's absolutely likely to play a role, not only in the economy, but in the merger and acquisition markets, all the way from Fortune 500 companies all the way down to small businesses. So, in particular, as the nominee for the Democratic Party becomes apparent, the tax policy that they will embrace it'll have an effect on all financial markets. And so, when we look at things like this of how politics potentially affect economics, we look at it in a very objective way and try to gather information without bias in any one direction with respect to politics. And so this is one of the things that we're hearing very often among clients and potential clients, is that they're very focused on how the election might impact the value of their business and ultimately on the taxes that they might pay in a sale. And so another theme, valuations. Valuations are at historic highs, really, for all types of equities, public and private. This has really been a theme for the last 2.5 years or so, and is likely to continue to be that way this year. All signs point to valuations remaining very robust for sellers, and deal activity likely being even higher than 2019. While recession risk is expected to increase as the year goes on, the large amount of capital, which will be another theme we come back to, that's available within funds, corporate balance sheets, in the economy in general, will continue to drive deal making. And trade policy, as I mentioned before, will continue to be a driver in markets, as well as a driver of really valuations and appetite for deals, as companies with higher exposure to more trade volatility tend to suffer from a valuation perspective at times. Last few kind of themes for the year. Interest rates, as you saw, are forecasted to remain low, and cheap debt will drive transactions. Anytime that credit is loose and rates are low, that's good for deals, because many acquirers do use some form of debt when purchasing companies. And the cheaper that debt is, the more they can pay for the company and have it still meet return hurdles. So that's always positive for deals. Cautious optimism will be the theme, I think, in general, and really all eyes will be on the Federal Reserve, trade policy, and the elections. One thing that, even though the majority of economists now do not forecast a 2020 recession start, if the economy starts to weaken, you'll see waters likely get choppier for a time, but one of the main differences in this environment than prior, call it economic contractions, is the amount of available capital that is hungry for deals. So that will likely provide a floor and a support for deal making. And last, in terms of themes, is that the U.S. really continues to outperform pretty much all other major economies in the world. And what we're seeing is more and more non-U.S. buyers look to buy companies in the U.S. Because they feel that the return on their capital is going to be higher with less overall risk than investing in their home country. So what does this all mean? So to kind of put this into a bit of a nutshell, and draw our key conclusions as to why it's a very good idea to look at selling your business this year. First and foremost, valuations continue to be at historic highs. There's an abundance of capital available for deals and hungry for good assets. Selling prior to the elections could prove very smart, because if the elections go the way that is viewed as being negative for asset values, not only will a post-election sale be affected by that from a theoretical perspective, you're likely to see a stampede of sellers, and all of a sudden the supply in the market goes way up and the demand dynamic isn't high enough to continue to support higher valuations. So you see valuations come down fairly quickly. Also, if taxes are ultimately changed or tax policy is changed, so that selling your company becomes less favorable from a tax perspective, it's better to sell in the current environment, so that you take more home after your sale is complete. And so also, kind of while the U.S. and China trade relations, war, if you call it, has started to cool off a little, and there appears to be a bit of a reprieve, it's a good time to capitalize on that, just in case that actually goes back the other way this year. So kind of the punchline here is close deals while the economy remains strong and before tax policy changes. And so for all these reasons, we are certainly urging clients who own companies to look hard at potentially exiting this year. It's a great environment and likely to be as good as it's going to get for quite a while. So with that, I will hand it over to Chris again. He's going to go through sort of the selling process, comparing an M&A advisor and a broker, and also just give you details in general of what to expect if you consider going down this road.
That's right. Thanks, Jason. I really appreciate that. So, let's talk a little bit about the selling process and, what is the difference between an M&A professional advisor and a business broker. I think it's very important to highlight. I think the first thing we want to talk through, though, is that the intermediary or the advisor that you choose to represent your business, it matters. It matters a lot. We're out there talking to buyers every single day. And the buying audience, unfortunately, by going through a broker process, will believe you have a subpar company, which can potentially translate or signal that you don't have strong confidence in your business. It means that, brokers, unfortunately, the types of companies that they're taking to market aren't thoroughly vetted. So they're simple, they could be commoditized, non-strategic companies, and not really worth anything more than just, a base multiple on cash flow. The buying universe, they understand this. They get the punchline that, one, there's potentially a lot of work that these buyers have to do when they're looking at these deals, but, these deals may not be so incredible. They also know that, that there's going to be bias towards you, that your company, unfortunately, is very simple and unsophisticated, and also maybe not worth that much. So, really the takeaway here is if you think so little of your business, then maybe you believe your business isn't worth much. So why, as a buyer, should I think it's great? So who you choose as an intermediary or an advisor, it actually does matter. So let's walk through that for a moment, just the difference between what is a business broker and what is an M&A advisor. A business broker is going to be someone who has a background in sales, probably a 1099 employee. They're really good at creating listings, really good at just a great listing agent. The sales process is very passive. It's hands off. They take 2 to 3 days to get your business to market. The offering materials are going to be very anemic, and they're not going to understand your company. So therefore, it's going to be a very passive sales approach. They're less selective. One of the ways that we like to talk about it is, just kind of taking all the spaghetti out of the bowl and throwing it against the wall, and let's just see what sticks. And unfortunately, what you tend to get is entry-level, true financial, engineers. They're not even financial engineers. They're just entry-level salespeople, effectively. So when you move over to an M&A advisor, and when you move over to someone who's got a strong background in, institutional investment banking like Global Wired Advisors, what do you get? Well, you obviously get that strong financial engineering background. You also get stakeholders. Here at Global Wired Advisors, we're 4 partners with a strong support staff. We're all stakeholders in this business. We're not 1099 agents across the country. We like to create opportunity for the counterparty. And what does that mean? We're going to dig into your business and we're going to understand your company. And like we like to say around here, better than you. And we like to carve out what the windshield looks like, not just what the rear view mirror is going to look like. We're going to dive in and invest and actively work to understand every single company that we take to market. And we have credibility with those counterparties or that buying universe. They know that the deals we're putting to market have been thoroughly vetted because we don't actually take everybody to market. We go through a fairly thorough process to ensure that the business that we're taking to market is a business that we know is going to be a great opportunity for a buyer. So that's really the difference, I would say, larger differences between a business broker and then M&A professional advisor. So why should this matter to you? Why should you care about this? One, there's a general mindset when going through a broker process and a bias towards your deal, and you don't want that. You're also going to miss out on buyers because they just choose not to work with certain firms. There's unfortunately bad reputations that are out there with deals that certain brokerages are bringing to market that, A, as I mentioned earlier, are going to be a lot of work for the buyer, and B, they just know that they're going to find something that might be questionable about the financials, the the company, the opportunity, or just the business in general. You're going to get a less than valuation. It's going to be below real market value. They're going to try and get your business sold as fast as possible, and it's going to be at the expense of you, meaning that you're going to go out there and probably leave money on the table. The other thing is that you're at a higher risk of retrade. So what does that mean? Well, they'll put a business out to market. They'll get lots of interest because it's well below market value. But then once they actually get into the numbers, because there wasn't a lot of diligence or due diligence that was done up front, more than likely, and this happens a lot with broker firms, you're going to get a retrade, meaning that the buyer is going to say, I know I originally said I wanted to pay this, but now I'm only willing to pay X, and you need to live with that. Also, if anything comes up at all that is questionable, you will never get the benefit of the doubt, period. Meaning that if a buyer finds anything inside of your financials or anything about your company that comes up that would be considered questionable, they're not going to believe you, and they're not going to believe the person that you've chosen to represent your business. So what's the big takeaway here? The big takeaway is an invested process versus a passive process. You know, when you choose to use Global Wired Advisors as the firm to take you to market, we're heavily invested from start all the way to finish. We just had a business close last week. The buyer and the seller never spoke to each other once until the closing dinner, period. And I think that's probably one of the greatest testimonies to how invested we are in this process. We are, you know, jungle scouts, as my partner Jason likes to say. We're jungle scouts and we're Sherpas. You know, we're going to take you along the journey and make sure that every single step of the way that we're highly invested to get this thing across the goal line at the best value that we could possibly get. So again, the big takeaway here, highly invested versus very, very passive. So with that said, I'm going to hand the next section over to our partner, Mr. Joe Hogg, to walk through valuation.
Hey, everyone. Before we get started, you know, I just want to make a couple of key points with respect to valuation. There are a lot of variables that go into valuing a business. And, you know, if we were to dive into in depth all of them, it would be a session webinar. So really what I'd like to do instead is just provide a good framework, a rough and ready framework for you to help you understand the value of your, because the truth of the matter is your business value is moving in the background as you do things or you don't do things with respect to your company. You know, there are certain things that you need to keep in mind irrespective of whether or not you're considering a sale. So with that, I'd like to go through high level really what the key tenets of that framework are. So in business valuation, you know, there are really three key approaches. And these three key approaches are applied fairly universally. They're applied, you know, in one degree or another by a buyer that's contemplating purchasing your business, or they're applied by an appraisal company that is looking at the value of your business to determine whether or not a buyer can make it through the lending process with respect to your company. So, these three pillars, if you will, are fairly important, and they're pretty key to that overall framework. So the first is the income approach to valuation, and that basically is just looking at the cash flow that your company generates, or the future benefit, or the current and future benefit. The market approach looks at the market value of your business. You know, what is a comparable business going to sell for? And the cost or asset approach looks at the replacement cost, basically the net asset value of your business. If we look at the income approach first, the income approach, again, being based on cash flow, is income statement driven. So if we look at a very simple income statement that's presented here, we have revenue less cost of goods sold less operating expenses equals net income. If we put back into that net income number, what we refer to as add backs, we get to a cash flow number, a current cash flow number. And add backs that we will typically use are going to be things that are related specifically to an owner, like salary. They're going to be non-cash expenses like depreciation, or they're going to be expenses that may not necessarily apply to a new owner of your company, like interest expense, because we don't know what the capital structure is going to look like for a new owner. In using the income approach and current cash flow, we can extend the analysis a little bit further, and we can look at future periods. We can basically say, okay, well, current cash flow today, based on the income statement, net income, and add backs, is X. Let's look at it and forecast it a year from now and 2 years from now, on a pro forma or future basis. This gives us a feel for not only what the company is going to do today, or a company is going to do today, but what it's going to do into the future. As you imagine, building pro forma and, modeling out cash flow has some pitfalls, because we don't know what the growth rate of revenue is going to be. We don't know what margins are going to be. We don't know what competitors are going to do to those margins. And we don't know specifically how much capital is going to be required. So, as valuable as current cash flow, future cash flow is in the valuation framework, there are some shortfalls that need to be considered. So the next approach is the market approach. And the market approach is really just arriving at a value for your company based on the characteristics of similar companies that have been priced already in the marketplace, or similar trades that represent your company in the marketplace. So, using this approach, there are basically three primary ways that it's applied. The traction method, which looks at specific transactions to a given company. So, for instance, if a company went through a funding round and they sold an ownership interest in the business, then we could use that transaction to determine value. We can also use similar public views. If a company is in a particular industry and it's very similar to a publicly traded company, we can look at that publicly traded company to get an indication of value. Obviously, both of these approaches are going to be more applicable to larger companies. The guideline transaction method, however, is a little bit more relevant in the Amazon space, because it's looking at full sales of companies with similar characteristics, where we are, for instance, looking at supplement companies and looking to see, where they were sold in their entirety, or pet, or companies in the, in the pet industry to see where they were sold. And we're pulling together those transactions to get a feel for what the current market is for that type of company. Now, as you imagine, that too has some weaknesses, because there really is not a perfect way to record the details of a lot of small businesses. When to kind of the lower rung of the lower middle market space, and you're into the middle market space, that data is more readily available, and we can see more of the specifics. It's public. But with smaller companies, there is definitely a data integrity issue. So we're not 100% sure that we're getting totally accurate picture. The other thing to keep in mind is that no company is the same. Companies are all different. They all have very unique characteristics. Even if they're in the same industry, even if they're in the same segment of an industry, they're just going to be nuances that make every business a unique asset. There's really no business exactly like another. So the cost approach, which is kind of the third piece of the framework, just basically looks at the net asset value of the company. It doesn't look at net income at all, or future net income or cash flow. It doesn't look at the market value of where companies have traded currently. it is basically just trying to solve for an enterprise value. It is looking at, in a way, just replacement cost. And as you can imagine, with that, the huge weakness is the fact that it's not taking into consideration what the company is going to do going forward. So, it is not a good way to figure out what a company is worth. So, the largest drivers of valuation in the market today, recurrent cash flow and cash flow multiple are how most people are going to value a company. So if we go back to the income approach and we consider cash flow, net income plus the add backs I mentioned previously, we can multiply that by a specific multiple to get to a business valuation. And those multiples vary. They vary by industry, by company. Again, no company is the same as another. But the important thing to remember is that cash flow and multiple changes can lead to enormous changes in business value. So an example that we have here, let's say it's a hypothetical company, in the first box that has $300,000 of cash flow, net income plus add backs, and we have a 3.5 multiple that we can apply to it based on company-specific variables and industry-specific variables and perhaps some market information. We get to a valuation that's a little bit over $1 million. If for some reason this hypothetical company's cash flow were to slip by just $25,000 and the business multiple were to decline slightly, going back to some of the points that Jason made with respect to I dropped. I don't know where I dropped. I guess the key point here was, again, these two variables, current cash flow and cash flow multiple, are extremely important with respect to valuation. And small moves, again, from 300,000 to 275,000 in cash flow, or from 3.5 multiple to a 3.25 multiple, can lead to a significant decline in value in this. The next thing that is a big driver of valuation is changes in projected future cash flow. Now, when we talked about the income approach earlier, we went through kind of the financial modeling aspect where we're contemplating future income statements and cash flow and, how best to model out the value of that cash flow. But in reality, most people are just going to look at the ability of your company to generate future cash flow, irrespective of financial modeling. Are there factors that are going to prevent it from being successful going forward that, are going to potentially dent some of the cash flow that it could make? That is going to lead to a lower valuation assumption, and that would probably be manifest in a lower multiple, current multiple applied to current cash flow. Mm-hmm. So another big driver of valuation is changes in historical Amazon business multiples. Again, as Jason was mentioning, we are late in the cycle. And, if we were to see a slowdown in the broader economy, there's no doubt you could see multiple compression. So, and it could be across all industries. It might not be unique to any particular segment. So if we see that, then obviously business valuation is going to turn lower, and this is something to consider not just at the macro level, but also in individual industries. Okay, so all that being said, how do you enhance value? Well, these are really the key ways that you can increase the value of your company. And again, as I mentioned early on, the value of your company is moving in the background. It's not being market, as we say, but its value is increasing or declining based on things that you do or things that you don't do. So the key attributes that enhance value are positive yearly sales trends. That's kind of an obvious one. If you are growing and you're growing market share year over year and quarter over quarter, that's obviously going to be worth more. Diversified customer mix. We don't like to see in valuation sales from one or two key customers, because there's obviously a lot of risk that those customers could change their minds and find other products. So we like to see cash flow revenue coming from evenly a number of different customers. Brand awareness and loyalty, that's a big one. If you have a recognized brand and you have repeat customer business, that is worth more. That's annuity-like business, annuity-like cash flow that people will pay a higher multiple on current cash flow for. Product differentiation, it's always good to have a different product because you're not competing. Competition's not as heavy. Product innovation, this is a big one. We bring a lot of companies to market where there's been a significant amount of product innovation that's brought the company to where it is today, but the pipeline of innovation is slowing down a little bit because the owner is thinking, hey, I'm going to sell, so I don't need to be as innovative or think about what the next 2, 3, 4, 5 years looks like. It's very important to do that. It's very important to always have a roadmap of where your product lineup is going to go well into the future. Barriers to competitive entry, it's key. You obviously don't want people biting at your heels all the time. You want to have moats around the products that you sell. Strong manufacturing and vendor relationships. This is getting a lot of renewed interest. It's being viewed as a strong competitive advantage now because a lot of manufacturing sources are very similar. A lot of vendors are have become somewhat homogenous. So finding efficiencies and working closely with manufacturing partners and vendors is a way a lot of people now are finding increased value. It's particularly important, and we're finding it to be particularly important with respect to what is happening in China with the coronavirus. We're looking at potential supply chain disruptions that a number of people are going to have to manage. So, the strength of those relationships is key, and they're going to be tested here probably over the coming months. Well-managed supply chain, very similar. You have to have an efficient supply chain to increase the value of your company. Robust management information systems. Can't stress this one enough. It's very important for the current owner as well as future owners to see where they are in the inventory cycle, in the supply chain process, and not be guessing, because that's to really capital inefficiency. It leads to the need to apply more capital when you really don't have to, or worse, it leads to stockouts where you don't have the opportunity to book additional sales. Transferability of the management model. At the end of the day, in order to achieve everything that we've laid out in the valuation framework, you have to be able to sell it. You have to be able to transfer it. If you've built something that is difficult to transfer, is difficult for a new manager to take over and run effectively, then it's going to impact value. So, all of these things, combine to create value. But again, the market is going to rely heavily on current cash flow and forecast future cash flow. So that concludes the presentation. I don't know if you want to take it over, Chris, if you have a few closing comments. Oh, you're on mute.
Sorry, I'm back. Kate's going to post a link to our valuation tool. And I think, coming off of a discussion around valuation, our valuation tool has a lot of back-end data that will help give, a potential seller a good range of where their business may or may not trade. Phrase that we use here in the office all the time is that the devil is in the details. So, while it's a good marker in the sand, we always encourage folks to reach out to us. We do consultations, complimentary. We will walk you through your numbers, walk you through what a view would look like going to market, and what a real valuation would look like for your business. And we do all of that complimentary, just to help you understand where you are as a business in relation to going to market. So, excited to hop into the Q&A. And I think, as we would, probably the best thing to say as we conclude everything, I hope that by listening to our webinar, you got, your audience and the audience listening got a really good idea that we truly do treat this process much differently. We're very thorough. We think through your deal a lot differently than the current process that's in the market. And we are excited now to start talking to you guys about any questions you may have.
I've been saving the questions that have been coming in through the chat. I did post that valuation tool, so you guys can go on there and kind of play around with that and check out your own kind of current valuation, where it might be at the time. I want to kind of throw my own 2 cents real quick. I think that you guys are so vital for business growth. I mean, just the conversations we have behind the scenes are so helpful for my own business that, you don't have to, yes, you want to build a business that you can one day sell and live off of. But I also think it's very important to have people in your corner and kind of advisors like you guys, helping you grow during that whole process. With my own, I'll hop down off my soapbox, and I'm going to dive into one of the first questions. Does business size, revenue, profit, etc., matter when deciding to go either with a business broker or a mergers and acquisitions advisor?
I'll let Jason or Joe take this one, just from a buyer's perspective.
Sure. Well, I guess the first important thing to consider is not really current size, but is future size, right? So I would say that if you're small, really the first thing to do is to look at how you could grow the company, because we see a lot of people that come to us that have smaller businesses, and they're in growing industries, and really they need a few tweaks to their business model, and in a year or two they could be at a much higher level of cash flow. And going back to the example that we laid out earlier, they could get significantly more money in a business sale. So I think before I would contemplate whether or not to go with a broker or, with, a little market investment bank and an advisor like ourselves, there probably should be a discussion about what the prospects for the company are. What are, some of the things that could be done to increase value? Because I think after that discussion, there might be a new way of looking at what you should do from a business sales standpoint. That's what I would say.
All right, next question. How would a mergers and acquisitions advisor bring more to the table than a business broker for simple brand / company like an Amazon only brand?
I'll take that one. I think, a lot of the difference is, a lot of what we discussed earlier, even for a quote unquote simple Amazon brand, there's still a lot of complexity that goes into positioning and selling your business. That's really where a professional advisor versus a broker is going to shine when speaking about your company to potential counterparties. we're going to be selling your business. You're not. And so when we go out to market to sell your business, we're going to highlight not just the obvious, but also things that haven't occurred yet. As Joe alluded to during his presentation about pro forma or future cash flow, that's an important conversation. And, you better have a really great both offense and defense when talking about the business, no matter how simple it is. Otherwise, through a broker process, you're more than likely going to be selling your own business. And so that actually could be the difference between getting a higher value for your business or a lower value, and or just finding the right buyer for your company versus finding the wrong buyer. And what I mean by that is, it could boil down to potential structural issues, when the buyer is actually bidding on your business. So.
All right, next question. Does having IP, patents, trademarks, copyrights, does that all add value?
It does indeed, because, that is going to create a little bit more of a moat around your business, around your operating model. So, they do. And, quite frankly, today, most buyers in the space are really kind of expecting trademarks and patents to a lesser extent. If the company has been around for 3 or longer years. So yeah, they do indeed add value. I would say that there's, again, somewhat expected.
All right, next question. What's the current multiple for Amazon businesses in the health and personal care industry? And in parentheses, they put supplements. So what's the supplement?
Supplement business. Yeah, supplements are a pretty hot sector right now on Amazon. And the thing to keep in mind with respect to the supplement industry is that most small companies in the space in supplements are selling on Amazon. You have a number of larger players that are brick and mortar, and they are some online, but the lion's share of M&A that's being done in supplements today is really very Amazon centric. So, the space being hot, it is it's commanding a little bit more of a premium off of the typical 3 multiple. And just to go into a little more detail on that, there is a market assumption today that 3 is the starting point. A 3 multiple on current cash flow is where you start. And you either add to that multiple or you subtract from it, based on positive factors about the company or the industry or negative factors about the company or industry. The starting multiple in the supplement space is somewhere in the range of 3.5 to 4. So, depending on, again, the company and what segment, the person is selling in the supplement space. So it is a bit higher. That's what we're seeing, somewhere in the 3.5 to 4. Just to note another industry that's pretty hot is the pet industry. The pet space is got a very rich multiple base to it as well. Just to throw that out there, if we have any folks that have pet-based companies, we would certainly be interested in talking to you and helping you.
And I know we've talked before too. Another one is baby. Baby products tend to do well right now. Correct me if I'm wrong, but it seems like that's something we talked about in the past 6 months, that baby products seem to do well too.
That's right.
They do. Go ahead.
All right. Jumping to the next question. I like this one. My brand relates to a cause. I like all the questions, honestly, but my brand relates to a cause. We donate to charity. Will this affect my ability to sell the business?
No, it definitely won't. It will not. Keep in mind that when we're building a valuation, we're looking at free cash flow. So the donations that are currently being made would in fact be considered an add back to net income. Now, a new owner would hopefully continue to make those same donations, but they could modify them. So, insofar as building a business valuation, they would be an add back and they would be an increase to free cash.
All right, next question. What is the fee structure? Can you guys there's a couple questions asking about different fees that you guys, obviously, we've all got to make money,
Sure.
But
I'll let
can you tell us a little about
right.
that?
Jason, you want to take that one?
Sure. Yeah, I would say that, in terms of the fee structure, one thing that I'll point out about kind of how we approach fee structures, we customize everything for the deal and for the client. It really is based on the particular attributes of that transaction and that company. But to speak more kind of in generalities, I mean, really, there's really two types of fees in the market when it comes to M&A. There's what are known as engagement or work fees, and then there are success fees. And so in this particular market, sort of, we'll call it the lower middle market, digital kind of business market, the engagement or work fee, landscape is everywhere from zero all the way upwards of $50,000 to $100,000 if you're going to use, a larger, kind of bigger middle market bank to do your deal. So zero is really for more like business brokers who really don't do a lot of work up front and don't need to charge work fees or engagement fees. And then the success fees are a percentage of the ultimate selling price of the business. Those also tend to range from 6 to 10%. Is kind of average, really based on deal size and honestly based on intermediary. It tends to fluctuate depending on who you're working with. And so from our standpoint, again, whether it's a work fee or whether it's a success fee, we're going to kind of come up with a structure that works well for everybody and kind of customize every deal.
Okay. Next question. Are private equity firms buying sub $10 million companies? And if so, do they just roll it up into one of their other portfolio companies, or do they operate it independently?
That might be a good one for you too, Jason.
Yeah, I'll jump in here. The short answer is yes. I mean, what we've seen over the last really 5 years or so is a big boom in kind of the lower end of the middle market for private equity investments. And that's not just roll-ups, but also platforms. And we've seen a number of asset managers go out and raise funds specifically to target lower middle market platforms. And a lot of times they'll do deals below 10 million for a platform, whereas historically, that would not be the case. It would only be for a roll-up. And for those of your audience that aren't familiar with those terms, very quickly, a platform would be kind of an initial investment for a fund into a particular industry. So that's going to really form kind of the base of their investing in that particular industry, whereas a roll-up is, kind of just an add-on to an existing portfolio company. So not only are we seeing more and more private equity firms dip down under 20 and 10 million and below, we're also seeing more and more private equity firms become interested in digital businesses and even, Amazon-centric businesses. So, and that's all something that's really been more of development in the last couple of years.
Next question. Is your focus only on product-based businesses?
I'll take that one. No, we're very agnostic when it comes to industry, but Global Wire does focus on digital businesses. We have we are very active in SaaS, IoT. We are active in taking digital agencies to market. Software companies, obviously consumer products. Am I missing anything, Jason or Joe?
We do affiliates too.
Yep, content, affiliate. We are We're very industry agnostic, vertical agnostic.
Next question. If we want to buy a business, what's your fee structure there? What does that look like on the buying side?
Well, I'll jump in on that one too. So if it's simply a matter of, purchasing a business that we're currently representing from a sell side perspective, the answer is none. I mean, there's no fees that you would owe us. It would be our client that would be paying all of our fees. If you engaged us for a traditional buy-side search, then those fees actually tend to be similar to sell-side fees in the market. So, a work fee typically, and then somewhere between a 6 to 10% success fee.
All right, next question. Would you guys be able to assist with Canadian-only brands / companies with a majority of sales being in Canada? Expansion to USA could be considered as future growth? ?
Yeah, I'll take that one. Yes, we can. Absolutely, we can. There's some nuance there, and definitely would be a conversation offline to kind of walk you through what that may or may not look like to take a Canadian or non-domiciled United States business to market. But the short answer is yes, we absolutely can do that.
All right, next question. This is another, we had our question about supplements, about what's that multiple. This is sports and outdoors. I don't know what exactly was sports and outdoors, but what's that multiple range look like?
I'll let you take it, Joe.
Well, you can. Okay, cool. So I guess we would need a little bit more than sports and outdoors. That is a popular category, broadly speaking. Though I think a lot of the businesses that we've brought to market that have been in sports, let's call it this category, the broad category, have commanded fairly robust multiples, just because a lot of those companies have a very strong lifestyle appeal, and we see a lot of people that are interested in the lifestyle aspect, and they're willing to pay a little bit premium on the multiple, to acquire the right business now in the space. Now, all of that being said, it is a sports and outdoors a pretty broad category. So I think insofar as multiple determination and value determination, probably the better approach would be to contact us and let us go through the details. Let us go through the specifics of the company so that we could give you a more accurate approximation of what we do.
Yeah, and it looks like Eric followed up on that, saying that it's outdoor recreation products for sports, outdoors, camping, hiking, fishing, and boating. And Eric, to answer your question directly, even more directly, I would say, as Joe said, there's nuance. We've taken, your type of company to market. We've had a few deals that look like yours, and so we're happy to set up a call, and we can walk you through what that may or may not look like. To Joe's point, there's going to be a little bit of nuance, but we are familiar with that space.
Next question. Do you have clients in software and electronic hardware in wireless space? And what would the multiples be in that space?
Joe or Jason, you guys want to take that?
Sure, I'll jump in.
I didn't hear the space.
Yeah, I'll jump in. Yes, the short answer is, from a software perspective, it really depends on, we're talking about SaaS, software as a service, or we're talking about, something else. I think that what we see with SaaS, for example, is, once you've reached over $1 million of cash flow, really you're of a size where deals start trading on a multiple of revenue. So 3, 4, 5, 6 times revenue. So it's below that, it's kind of a weird dynamic where if you have a software company, a SaaS company that is only got say 200,000 of cash flow, you tend to price more on cash flow than revenue. So it's a bit of a kind of, there's a break point in there. And then as far as kind of the hardware goes for wireless space, I think are we talking about consumer? Are we talking about enterprise? I think that absolutely makes a difference. I think that if we're talking about consumer and it's branded consumer hardware that's related to wireless, I would say that in terms of comparing to medians, I'd say it's probably about in the median range. I wouldn't say that it's something that people kind of dislike, and it isn't something that we've seen people kind of go crazy for. So it's kind of a down the middle on that one, based on just the assumption that it's a hardware. Let's say, for example, like a branded wireless charger for a smartphone, as an example.
All right. Next question: what impact do product reviews, number of reviews, and rating have on the valuation? How's that factored in?
I'll take that one. Yeah, I mean it's may not necessarily have a material impact on the valuation from a numbers perspective, but what it does is as we're taking your business to market and we're showing the market all of the good things about your company, having great reviews, a 4.9, a 4.8, these are all nuggets that we're able to use to help make your business more attractive to the trade, because typically there's a reason behind that. You've got high quality product. You've got a high in demand product. I could go on and on, but I think everybody gets it. So it may not necessarily increase your valuation from a numbers perspective, but it absolutely can help make you look more attractive. Jason, Joe, would you guys add to any of that?
Yeah, definitely. I would say that, strong reviews are really somewhat in the trademark patent category. Going to market, a lot of buyers, most buyers, are going to expect you to have strong reviews. They're going to have a lot of reviews. So if you don't, or if there's a trend in your reviews where they're slipping some, then that could cut against you somewhat. So I would say, yeah, they're very important with respect to bringing the Amazon business to market. They're expected to be strong, and they're expected to not be at risk.
Right. I did post your guys' calendar in the chat, so hopefully that's okay with you all. But if you guys have more specific questions for Joe, Chris, or Jason, you can go ahead and book some time with them there. I'm going to end with this last question, but again, just wanted to point out that link is there. This is our final question. Is there a legal business structure that's best for valuation? For example, would an LLC somehow get a better valuation than if the business were an S Corp?
I'll jump in on that.
You can take that, Jason.
Yeah, I'll jump in. The short answer is really no. I think most sales in the private company space tend to be asset sales, which, again, without getting too in the weeds, really takes the ultimate corporate structure out of the equation. On kind of the off chance that it would be an equity sale, selling the equity in an S corp versus selling the membership interest in an LLC, there's really not a material difference there. There's always a tax analysis that can make the difference, but it really hasn't. It's not specific to a type of legal structure. It's more deal to deal and what has occurred inside of that company in the past. So there isn't necessarily a better one for a sale. I will say that it is more difficult to sell a kind of a sole proprietorship that has no real corporate structure, that's really been run as just kind of an individual business without its own separate entity and its own separate bank accounts and so on and so forth. So that one definitely becomes more difficult, but in terms of whether C Corp, S Corp, LLC, it's all pretty similar.
All right. Well, thank you guys so much. Again, if you have any other additional questions, thank you all for joining us. You can book some time with the guys, and chat with them more. Thank you for all, as always, Joe, Jason, and Chris.
Yeah, thank you, Kate.
Thanks, Kate.
You guys are just pleasant to talk to, and I always learn something new. So thank you. Again, we did record this, so if you missed any of it, I will be sending it out later today. Thank you all. Have a good day.
Thanks, everybody. Take care.
Thank you. Yeah, thanks.